Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Nadal, founder and chairman of Peerage Capital, to discuss trends and outlook on home ownership. Miles, it's great to have you with us. Welcome to Trade Talks.
It's a pleasure to be here. Thank you very much for the opportunity to speak with you.
All right, Miles, you got it. Let's talk about interest rates and impact on the consumer, as there's this view out there that inflation may be easing. What are your thoughts around that?
So you have to take a step back. In the last 50 years, average interest rates on a 30-year mortgage were 7.73%. Okay. In 2021, at the absolute bottom, they were 2.36%. Now they're about just under 8%. The challenge is not just about where rates are, it's the ascension from the bottom in such a short period of time. Essentially, in 2.5 years, you've had rates triple. And that's what's really affected two things: the fundamentals of affordability for the consumer on their mortgage, and the psychology of the uncertainty of where do rates go and what does this mean. You have a huge imbalance still with demand exceeding supply, but supply is, the volume of transactions is down to a record low of 13 years. So today they published that resale of houses is down to 3.79 million houses. In 2021, it was 6 million. In 2022, it was 5 million. And this year, as I said, it's at about 3.79 million, which is even lower than NAR had anticipated at around 4.2, 4.3 million. We believe that rates have, at worst, peaked and should start to come down over the next 12 months. Whoever knows that answer is a very smart person, but other than the Lord, I'm not sure anyone does know. But if you said to me, Jill, if we had this meeting 12 months from now, this interview, do you think the probability is that rates will start to come down? And I believe the answer is yes. Whether they come down 25 or 50 basis points between now and the end of 2024, or 100 basis points, no one knows. I think what's really important for consumer confidence, and that's all consumer confidence, especially real estate, is knowing that rates are coming down. And it is of the belief of most people that by the end of 2025, rates will come down about 200 basis points. So we should be looking at a 10-year at around 3.5%. And if that's the case, then you would see mortgage rates probably come down at least that much. And a 30-year mortgage of around 6%, 5.5 to 6% would be very palatable and would change the consumer buying behavior and the volume of transactions in real estate.
Right. And Miles, to your point earlier, it's the velocity at which rates went up in just such a short time. So the expectation for as quick as they went up to come back down certainly is probably one of the things you can be certain about, that it's not going to look like that on the inverse. So let's talk about the changing face of residential real estate. With every economic cycle, businesses emerge with some structural changes. How do you see the real estate market being affected as a result of higher rates, inflation, changing technology, working from home, among other factors?
Look, over the last 50 years, there have been lots of things that have affected real estate, whether it be construction costs, whether it be availability of labor, whether it be the cost of capital. But the American dream of owning a home, which I call the universal dream, whether it's Canada, or United States, or Europe, or wherever else, has always been there and will continue to be there. And for just about every single consumer, their home is their most valuable principal asset and will continue to be so. Look, when I started in 1980, I started in business, interest rates peaked at 18.36%. Okay. But we survived. You know, rates were much higher during the 2008 financial crisis. But as you know, this too shall pass. And I still believe that the purchases of homes will be a principal focus of the consumer for decades and decades to come. The affordability issue obviously is easier to deal with lower rates. But I believe, especially in markets like Florida and Texas, where you have the wind behind your sails by not having state taxes, you've got a lot more demand into those markets. But I still think universally across the country, across North America for that matter, the demand for housing will continue to grow. And right now, with so few houses trading, I believe the imbalance of demand over supply continues to accelerate, and that will eventually right itself over the course of time. But Jill, you said something that's very important. We had a rapid ascension of rates in a very short period of time. The consumer is now starting to realize that it's going to take longer for rates to come down. And inflation, the same thing. We are in the higher for longer business, but if you saw the data published today, the inflation, the effective inflation is less than 3% today. So it's getting into the realm of reasonability of where Powell wants to see it. He wants to see it at 2. So we're not as far out of whack as we were before. I think that the one area that still there are 2 areas that are having an impact on inflation in a inflationary way. One is labor still, and the other one is still housing. But they're coming down. And I think intuitively, if you look at the rest of the economy, you see that things are slowing down, that prices are softening. And I think you're going to see on Black Friday, I think you're going to see a much less robust retail market, and also for Christmas, in my opinion.
I also think we need to recognize, while we might see headline numbers coming down in terms of inflation, just look how much car insurance went up, housing insurance went up. These are, with the exception of wages, these are things that are not transitory. You're not going to automatically get a discount when it comes to housing insurance, car insurance. Some of them are up nearly 10% since 2019, early 2020, when the pandemic started. So I feel like it's a double whammy for the consumer in terms of housing prices, and then all the other factors that go into it. I mean, insurance cost, 10% higher than it was 2-3 years ago is a big factor when it comes into purchasing a home. It's not just the purchase price and the mortgage payment that you think of. It's, all the other things that go into home ownership.
But on the other hand, fuel is at a 12-month low. You've seen construction costs come down materially. You've seen commodities come down materially. You've seen some food costs come down materially. So there are offsetting checks and balances. But what you said is also true. But if everything was coming down, we'd be at or below 2% already. So this is why it's taking time for inflation to come back into range where Powell would like to see it.
Right. And Miles, as you know, you can never time the market, whether it's housing, stock market, bond market. So I think, going in with it, that the adage, you cannot time any kind of market, is particularly true in this case.
Well, look, Warren Buffett always said, in the short term, the market's a voting machine, but over the long term, it's a weighing machine. If you have the objective of owning a home to support your family and create a lifestyle for them, and you are in the position to afford to be patient, you will be happy to own a home anywhere in North America over the next 10 to 25 years. I can't say where the next 10 to 25 weeks or months are going to be, but it's my belief that it's still a very sound investment, and you are going to be in a position where you see values continue to appreciate. And it's one of the most cost-effective ways of creating wealth for a family is in their own principal residence.
All right, Miles, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Pleasure. Nice to see you. Hope you all are doing well for the holidays.